Hi, I'm James Kirby, Managing Editor of Eureka Report, and today in our series, Getting Set for the Year Ahead, I want to look at hybrids. That, of course, is a part of the fixed interest market, part of the equity market. It's a hybrid. Charles is going to talk about how we deal with hybrids and the outlook in the year ahead. Hi, Charles.
Hi, James.
Now, let's just put it on the table that in Australia, for private investors, hybrids have really a disproportionate size of allocation in many people's portfolios for the simple reason we don't have corporate bonds like the US. We certainly don't have much retail-based treasury bonds. They'll come in time. But for the moment, we've loads of hybrids. People are in hybrids, especially bank hybrids. What's your core view on hybrids? Do you ever recommend them?
Well, they have got a place. They're all very different, of course. They've all got their different moving parts. You know, some are resets. You know, they've got different security and all the rest. So you have to be careful about which ones you actually want to buy.
Have they become more complicated in recent times?
Oh, yeah, I think they have.
Keep coming up with innovations.
That's exactly right. As far as, I guess, to the question of position in portfolios, I 99% of the time prefer to own the stock rather than own the hybrid, because the actual risk, when I say risk, I mean the ultimate risk of the company going broke. If one of these, if ANZ or Westpac went broke tomorrow, you'd get about a zero return whether you're in a hybrid or in an equity.
I understand that from a textbook point of view, but investors are saying, hey, I don't think any of our four banks are going to go broke. So then the dividend or the yield is way better than the share. Yeah.
So then you've got the just the aspect of when you own the hybrid, you're not getting dividend growth necessarily because they're all fixed. Generally, some of them move in line with the interest rates, which is actually a risk on its own, because if interest rates fall, the actual return falls. But the theory is you actually get you can redeem them in 3, 5 years, however long the period might be. So from that aspect, the fact that they're not volatile, if you equate volatility with risk, they're certainly less risky than shares. I don't necessarily equate volatility with risk.
But actually, they fall like a share, don't they? When things go bad.
They did in the GFC.
Yeah, that's why they're called hybrids.
Yeah, that's right.
But do you think there would, now that we get a recovering share market, do you think maybe this golden era of hybrids might pass? Every
market seems to have its demand, and the demand is filled by investment banks, or a specific demand. So the hybrids, I think, were a child of a very sort of unique set of events. You had the GFC, of course. People were very, very scared of getting back into equities. You had the banks with the way the APRA rules work. They actually had to change a lot of their capital structure from debt to equity. So that's why the hybrids actually came about. They're debt-looking instruments, but on the balance sheets they're quite often equity.
Very useful for the issuers.
Yeah. So a unique set of events has created this instrument, which was, as you say, useful for the issuers, but also a good investment for those people that didn't want to take the equity market risk, didn't want to put the money in the bank, didn't want to buy a property. So I don't think you're going to see the huge growth in them in the next sort of 12 to 24 months that we did have over the last 24 months.
Just one last question. Do you distinguish between the bank hybrids and other hybrids on the basis that there is a de facto guarantee? This was an explicit guarantee to some degree and a de facto guarantee on our big four banks.
Yeah, I think conceptually and probably technically that the banks are generally, as I say, perceived safer, and they probably are safer. But of course, every issue, even within the banks have a number of hybrid issues, some of which are actually safer than others, some which have a slightly higher return. So you've got to analyse, even hybrids within one bank, you've got to analyse those against each other. And quite often you can actually shift in and out of different hybrids to get extra 0.5%, 1% return.
Okay, so the point you're making, I suppose, is to watch them carefully, to know that, yes, there is yield there, but you're taking equity risks. And to know that, and to know it's not a bond, it's a hybrid.
That's right, and know what you're buying.
Very good.
Yeah.
Thank you, Charles.
Thanks, James.